right, welcome back to the Financial Shepherd Happy Hour. My name is Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. Very excited to be back here for our happy hour this week. Sorry we're a little late here today with some technical difficulties, so couldn't get the camera working exactly the way we needed it to. But we're going to use the old trusty iPhone here to knock out this week's episode. So cheers to technology. Hope you guys are having a great Friday. That's a much better way to get started here with the show. So for today and this week, a lot has happened. A lot of new news has come out, and certainly a lot more to look forward to in the coming weeks here. So as far as the week goes, it's definitely a rough week for stocks. The S&P 500 being down more than 2.5%. The Nasdaq's down more than 3% this week, with the Dow Jones being down almost 2.75%. Russell 2000, your small caps are down about 2.8% for the week. So it certainly was a rough week for the overall major averages. And a lot of it had to do with the hotter than expected inflation report that we received this morning at 8:30 in the morning. However, one of the things that has been a little annoying from the seat that I sit in is no one's really talked about the impact of shelter in the inflation calculation. So just so everybody knows here, the Bureau of Labor Statistics obviously, was responsible for sharing a lot of the data that we just got this morning, and shelter accounted for 33% of the overall index weighting, which is still showing positive inflation there. And I think, I'm a landlord. I work with a lot of other clients that, have rental properties. I think everybody that's out there in this country can see the fact that lumber prices, copper prices, all the things that go into making a home or fixing a home, a lot of those things are simply back down to normal price levels, or some are even below pre-pandemic price levels. Obviously, with interest rates, increasing as much as they have, the housing sales have slowed down significantly. I think anybody in the real economy, not just looking at historical data for shelter. So one of the things that's interesting about shelter, as a landlord, you only do a tenant lease about once every year. For most landlords will do that, which means a lot of the data that's showing up in this inflation calculation from shelter, again, being 33% of the index for calculating, the numbers we see on inflation, being the biggest overall weighting by far in the overall calculation. I think that most people can flat out see, that there aren't increasing prices. There's not inflation in the housing market. The Fed chairman himself, on February 1st at 2:30, when he made his announcement that, hey, we're going to increase interest rates again, he also came out and said, we can see, the lag effect in housing. It's not showing up in the data yet. We know that it will. We can see deflation in that specific sector. And again, that's 33% of the overall inflation calculation. Nobody's talking about that. And it's just simply going to take a little bit more time before shelter deflation starts to show up in the inflation calculations that we see as retail investors and consumers, almost every month. And again, 60% of the total increase in inflation came from that specific sector being shelter. And it's simply because it's the biggest weighting in the inflation calculation. So food for thought out there for everybody that's, in the bearish camp. It obviously was a rough week for stocks. The S&P 500 fell, 5% from its recent highs, and skeptics are top calling right now, basically saying, the bear market trends will continue when in fact we are actually in an uptrend. If you go back to October of 2022, all the way to now, it was just simply a rough week. And a lot of it had to do with, again, the inflation report that we got this morning. And of course, we had a very strong jobs number that came out in January. So I understand the logic that a lot of market participants have, like, hey, the job market's so strong, inflation seems to be stubbornly, not going down as fast as we would like it to see. Therefore, the Fed has every reason to increase rates and keep them higher for longer. I think the Fed is saying the right things to keep the trend of inflation going lower. And all of this is certainly working in the Fed's favor as far as the market starting to pull back some of the recent gains that we got in January. But the fact of the matter is the major risk of the market is definitely the Fed and what they're going to do with rates and how that relates to the impact on inflation. So obviously, if we keep rates higher for longer, it makes it a little bit more difficult for stocks, specifically small caps and technology stocks, to continue to lead the way like they have so far this year. But I think we can all kind of look through that. I think that's the main reason why the market didn't just straight, shoot down after the news that we got here from the job labor market, as well as the inflation report. I think that when we get into March, we will get another inflation report before the Fed meeting on March 21st and 22nd, when they'll announce what they're going to do with interest rates relative to the data that they've received regarding inflation. I think the market's pricing in a 25 basis point increase in March, and I don't expect that to change too much unless we get another very hot inflation report, which I do not expect. You can look at the overall, calculation for inflation, and about 40% of all the metrics they use to calculate that are flat out deflationary. And Jeremy Siegel, if you guys want to, Google him, he's on the CNBC halftime report quite a bit. He's a Wharton School professor for about 50 years, I believe, studying under Milton Friedman. I mean, some of the best, economic minds that we've ever seen in history. And he actually used the current inflation figures for current data for the housing sector, and you actually would have had a negative inflation report. So again, that's coming. I think that's the main reason why the market didn't sell off, very hard today. I think a lot of people are starting to see through some of the numbers that we've seen from the job market, as well as the recent inflation report this morning. And I expect the numbers to start to show up here in the coming future, and that certainly will be a major benefit for stocks. Now, going back to history, so a big part of the reason why we like to do this happy hour is not just to have some fun with your favorite beverage, talk about recent market events and trends, but we also want to take a look back at similar events in history so we can begin to plan accordingly going into the future here. Now, obviously, for the folks in this industry that I work in, as well as the regulators for this industry, past performance is no guarantee of future results. However, Warren Buffett famously said, the one thing we know for sure about human beings is they have not learned from history. So I like to bring a little history to the discussion here so we can learn from it and prepare accordingly. If we go back to 2007, looking at inflation data from 2007 to now, and if you begin to look at 2007 year by year, inflation, even though we had a very low inflationary environment, I mean, for 13, 14 years, we had basically zero interest rates for, that length of time, which is unprecedented. Obviously, the stock market did very well, but even in those times, January and February seemed to be the 2 months that had inflation that was much higher than any other month. And then again, that was during a period of time where we had very, very low interest rates, but we still saw inflation in January and February. And to me, that kind of makes some sense because there's still a lot of seasonal shopping, people going out, spending money around the holidays and the New Year's, and all those sorts of activities. If we go back much further, so everybody's talking about earnings per share, EPS, bottoming out this year. The revisions need to come down. Earnings per share has been very resilient. It hasn't been phenomenal, but it's certainly been a lot better than analysts and market pundits had expected coming into this year. But since 1930, equities bottomed, the stock market bottomed 11 to 12 months before earnings per share bottomed. That's very important because the bottom is October of 2022, specifically October 12th, 2022. And that is the market bottom thus far. I don't think that anybody's calling for a retest of those bottoms, at least very, very few people that you would see on major news outlets in the financial sector. But 11 to 12 months, the market will bottom before earnings per share will bottom. I believe that we already saw that again back in October of 2022. So earnings per share fallout is certainly not likely to happen here in our view relative to what has already happened in October of last year. Furthermore, if we go back and look at similar rate hiking cycles, I talked about this in our latest podcast. You can check that out. Go to our website, shepherdwm.com. There's a link to our podcast channel, and you can take a look at the most recent episode that we did there. But going back to 1970, there's been 14 rate hiking cycles. And 11 of those 14 cycles, we saw positive equity markets, or equities were actually rising. And then going back to that earnings per share conversation, in my view, based on data and history, the VIX, the volatility index, is much more important to look at than earnings per share. And this is going back over the last 30 years. So post-negative years, which is what we're in right now, since 2022 was a negative year, so post-negative years, over the last 30 years, if the VIX falls and stays below that 25 level, which we're seeing right now, equities gain on average 22% gain. and that's a win ratio of 83% of the time. So 23 instances that occurred over the last 30 years. Now, when the VIX rises, which is what we're not seeing right now, rises and stays above 25, which is what happened last year in 22, equities lose on average 23% in a market year. The win ratio is only 14%, and that occurred 7 times over the last 30 years. However, when we shift it over to earnings per share, so if EPS growth is negative year over year, which is likely to happen, we're already seeing that with the revisions, the median gain for stocks in a year is 14.8%. If EPS grows positive year over year, which we're likely not going to see, the median gain is only 15.5%, again, over the last 33 years. So earnings per share is certainly not the main driver for what the market is going to do this year relative to what history has had to say over the last 30 years. Really need to pay attention to the VIX. VIX is staying very stable and low. And we're seeing the U.S. dollar fall, and we're seeing a ton of deflation across all the economic cycles. We're just unfortunately going to have to wait a little bit longer for that to show up in shelter, just due to the nature of the way that this is calculated. So that's the news of the week. Those are trends that have happened, and we take a look at what history has to say. So with that, I want to wish you all a very happy Friday. Enjoy your weekend, and I look forward to seeing you all again next week. Take care.